Yesterday's tech sell-off wasn't a normal dip. It ripped a hole in the order book and exposed a liquidity trap sitting exactly at 7,422. If you're watching the S&P 500 right now and feeling like the floor is about to vanish, you're not alone, but that feeling is exactly what the market is counting on. There is one danger zone and one hidden opportunity right now, and I'll show you both. Stay until the end because I'm giving you 3 exact levels you can trade tomorrow, complete with risk-reward ratios that make professional desks stop and look. Here's the session bias. We are in a high volatility, range-bound fade with a bearish tilt until proven otherwise. The daily trend is a sell, the 5-hour is a strong sell, but the monthly and weekly charts are screaming strong buy. That disconnect is a trapdoor. The single invalidation level that flips this whole structure is 7,422. Write this number down. If we get a 4-hour candle close above 7,422, the entire bearish argument resets, and we chase the melt up. Right now, price is at 7,386, sitting below the pivot point of 7,422 like a coiled spring beneath a heavy lid. The herd is positioned short, piling into puts, convinced we are about to cascade into freefall. That level of consensus is dangerous. When everyone sees the same breakdown, liquidity dries up, and the move either snowballs or reverses violently in a short squeeze. The next few hours are a liquidity tide waiting to rip. Let me walk you down from the weekly canvas to the 60-minute noise, because the structural story is everything. On the weekly and monthly, the S&P 500 remains a fortress of strength. The 200-week moving average is light years below us. The 50-week MA is climbing, and we have a massive runway of higher lows. But the daily chart has just printed a sell signal, and the momentum is deteriorating. The 20-day moving average sits right at 7,444. That's your short-term trend proxy. We've sliced below it cleanly. The 5-day MA is at 7,448, the 10-day at 7,474, and price is now trading beneath all of them. That's a short-term trend break. Zoom into the 4-hour and hourly. The 50-day moving average, 7,271, is far enough away that it acts as a gravitational pull if we crack intermediate supports. But the 20-day exponential, the 2-hour level, is acting as dynamic resistance. On the 4-hour, the MACD has just gone negative. This is the hidden divergence most traders miss. While price made a lower low, the MACD histogram printed a shallower trough, hinting that selling momentum is stalling. However, the daily MACD line is still at an elevated 83.8 and just starting to curl down, which means the real bearish pressure hasn't fully unleashed yet. The ADX on the daily is above 31, so this trend, although young, has strength. The CCI is deeply oversold at -131, and RSI is at 48.9, not yet washed out, but close to the line where mean reversion becomes probable. Now, here's what most traders miss. The exact support and resistance levels matter, but they are not static lines. They are zones where gamma flips and liquidity pulls. Our support 1 is 7,378. That's the line in the sand from the last swing low. Below that, support 2 is 7,350, and support 3 is 7,306. Those levels are clusters of buy-stop orders and dealer gamma hedging. On the upside, resistance 1 is 7,449, the prior value area high and the 20-day MA. Resistance 2 is 7,492, a volume gap fill. Resistance 3 is 7,521, which would confirm a breakout of the entire month's range. The pivot point, 7,422, is currently the magnetic midpoint of the session and the exact battleground where algorithms will decide fair value. While gold is moving tick for tick with collapsing real yields, the S&P 500 is inversely dancing with the VIX. We saw a VIX spike above 22 yesterday, meaning options dealers are short gamma and forced to hedge by selling futures into weakness, exacerbating the drops. That's the gamma wall effect. Once we broke below 7,422, dealer hedging accelerated the sell. But if we reclaim that level, the same dealers will be forced to buy back, creating a slingshot. That's the hidden opportunity. Yesterday's core news was a double punch. Tech selling resumed as names that led the rally got gutted. Semiconductors and AI plays saw heavy distribution. Then, Trump's statement vowing to respond to a downed U.S. helicopter injected a geopolitical risk premium that wasn't priced. The market went from soft landing narrative to risk-off scramble in 60 minutes. The Nasdaq fell in sympathy, and the S&P 500 got dragged down because correlation spiked to 1. This isn't a fundamental collapse of earnings yet. It's a positioning squeeze. What's the institutional read? Large funds are rotating from mega-cap growth into value and defensives, but they are doing it with put protection rather than outright selling, which means we are in a broadening pattern, not a crash regime. ETF flows yesterday showed outflows from SPY and QQQ, but some of that went into cash, not into shorts. The big money is hedged, waiting for the Fed's next whisper. The 2-week directional lean. I expect a range between 7,350 and 7,450 to hold until we get a catalyst. The event that invalidates this call is a daily close below 7,306. That would signal the weekly trend is cracking and open a door to the 50-day MA at 7,271 and eventually the 100-day at 7,086. Think of the S&P 500 right now as a risk asset shadow of the bond market. If real yields keep ticking up and the dollar stabilizes, stocks struggle. But if geopolitical fears cause a flight to safety and yields drop, equities could actually catch a bid on a Fed pivot hope. It's paradoxical, and that's why this level is so tricky. Here's the first interaction trigger. Do you think the S&P 500 closes above 7,422 this week? Comment yes or no right now. I'm tracking consensus, and the herd is usually wrong at extremes. Most people skip this section. That's exactly where the money is made. Keep watching. I'm going to give you 3 sniper-level trade plans with exact levels, stops, and on-screen graphics that you can screenshot. After strategy 2, I want you to type your S&P 500 range for tomorrow in the comments. Let's see who's aligned. Strategy 1, the sniper, conservative. This is the high probability, lower frequency setup that waits for the trap to spring. The entry trigger is a 1-hour candle close above 7,422, with confirmation that the next candle makes a higher high. That reclaims the pivot and flips the daily bias to neutral bullish. The stop loss goes below the hourly demand zone at 7,370, so 7,370 stop. That's a clean invalidation because if price drops back below that, the reclaim is false and we re-enter the range. Take profit 1 sits at 7,449, right into the 20-day MA and the first resistance pivot. Take profit 2 is at 7,492, filling the volume gap. The risk-reward on this is 1 to 3.1. This setup is void if we get a 4-hour candle close back below 7,400 before hitting the first target. That signals a failed breakout and we exit the sniper, conservative. Entry, 7,422, 1H close above plus higher high, stop loss, 7,370 take profit 1, 7,449 take profit 2, 7,492 risk, reward, 1:3.1 are invalidation, void if 4H candle closes below 7,400 strategy 2, the active trader, standard. This is a mean reversion fade at the oversold extreme. Look for a 1-hour RSI to dip below 30 with a bullish hidden divergence on the MACD histogram at the 7,350 support. The entry trigger is a hammer or bullish engulfing candle on the 1-hour chart that closes above 7,355, confirming that buyers are absorbing the sell-side liquidity. Stop loss goes below the wick low and under the demand zone at 7,320. So 7,320. That's $4 below the structural low. Take profit 1 is the pivot at 7,422, a 70-point move. Take profit 2 is the same resistance at 7,449, just below the 5-day MA. Once target 1 is hit, move the stop to break even and trail with a 20-point buffer. The risk reward here is about 1 to 2.8. This setup gets invalidation if the 15-minute chart prints a lower low that breaks below 7,340 without a bounce. That's a sign of a waterfall. The active trader, standard, entry, 7,355, 1 HM close above, stop loss, 7,320 take profit 1, 7,422 take profit 2, 7,449 risk, reward, 1:2.8 R invalidation, void if 15-minute candle closes below 7,340 now. Before the aggressive play, I want your participation. Type your S&P 500 range for tomorrow in the comments. Give me a high and a low. Let's see who nails the session. I read these before the next video. Strategy 3, the aggressor, high risk. This is for the momentum traders who can take a tight stop and accept losses quickly. We are looking for a break and stack below the critical support at 7,378 with heavy volume. The entry trigger is a 5-minute close below 7,376, and then a second 5-minute candle that fails to reclaim 7,382, confirming the breakdown. That's a short entry. Stop loss is tight above the breakdown candle high at 7,392, just 14 points of risk. Target 1 is the liquidity void at 7,306, which is our S3 support. Target 2 is the big psychological level at 7,271, the 50-day moving average, only if volume stays elevated and VIX spikes above 24. This trade is a 1 to 4.8 risk reward, but it's fragile. It gets voided immediately if a 15-minute candle closes back above 7,390. That's a bear trap and you must exit. Only for those who can lose small and manage risk aggressively. To the aggressor, high risk, entry, 7,376, 5-minute close below, then fail to reclaim 7,382, stop loss, 7,392 take profit 1, 7,306 take profit 2, 7,271 risk, reward, 1:4.8 R invalidation, void if 15-minute candle closes above 7,390. Never risk more than 1 to 2% per trade. No positions through high-impact news like the jobless claims tomorrow. Stops are non-negotiable. If one of these levels breaks, you're out, no questions. This is how you survive to trade the next big move. The single most critical level for the next session is 7,422, a daily close above it, and the bull trap transforms into a bull breakout, a failure to reclaim, and the freefall magnet at 7,350 becomes the path of least resistance. Tomorrow's wildcard is the US initial jobless claims and any follow-up on the helicopter incident. A tweet or a headline can slam this range. If you want the full breakdown on Bitcoin and the S&P divergence, that video is live now. Tap the end screen. Smash like if this gave you a clear plan. Subscribe, hit the bell, and I'll see you in the next one, before the next trap.